Hello guys, well guess who is back? I know I've been out of circulation for a while, but I can truly say that was due to COVID. But everything's okay now, I'm back and I hope that I can just continue these lessons for you. Just one thing I would like to add before I get started is, as you know, a lot of students have subscribed to this channel, and well, I've been trying to help as many of them as possible through the emails that you guys send, and I try to answer as much as possible. It's not always possible, and because I've got over 1,000 subscribers and I get a lot of emails, it's been a bit difficult for me to get to everything. So what I decided to do was I actually started a Facebook page called Carlo's ICB Students. So the purpose of this page is for students, when they battle with a question, just to, just post it on there, and then hopefully there are other students that will be able to help them if I can't get to it. The carlohelp at yahoo.com email address will still be active, and you guys are still welcome to use it, especially if there's certain documents that you guys would like for me to send you. It's just easier if you just send me the email. So if you want, you're welcome just to follow the Carlo's ICB student Facebook page. And like I say, raise some questions there. See, there should be a lot of other students that might be able to help. Because I've really battled to get to all the questions, so I would appreciate some help if you can. But like I say, I will also still be available. I'll be checking the messages myself, and I'll still be checking my emails. But if other students can help, that would just be awesome. Okay, so I am actually starting with financial statements, and that's one of the subjects I've received a lot of emails about. People asking, please, when are you doing lessons on financial statements? Or that and income tax. I'll probably do income tax later, hopefully. So I decided to start this one on financial statements. I just want to forgive me, I honestly cannot remember your name, but the lady or person who actually scanned in the entire textbook and sent it to me. So thank you very much for that, and I'm sure there's a lot of students that are thanking you for that so that we can do these lessons. Okay, so all the technicalities are passed, so go join the Facebook page, and let's just continue. All right, so first of all, in financial statements, the first learning module is recording business transactions. Now, I've already done all the lessons with regards to bookkeeping to trial balance. Learning module 1 is just a recap of basically that entire course of bookkeeping to trial balance, and by the time you do financial statements, you should have done bookkeeping to trial balance. If you haven't, I have got all the lessons on YouTube for that. So you're welcome to follow it. So there's not really anything I'm going to do with regards to learning module 1. Okay, so sorry, I've got a lot of papers, believe me. Financial statements takes a lot of preps. I do hope I do make sense as I try to explain all the funny stuff that I think you guys are well familiar with. Alright, sorry, you can just move there, move up there. Okay, now we're getting to learning module 2. And learning module 2 is all about depreciable assets. Now, I know I can remember when I did this course, when I did financial statements, I think I stressed most about learning module 2, about depreciations, and it was like a total freak out because there's all this information, all that stuff, and I hope that I'll be able to help you guys with it to just try and understand it a little bit better. Okay, so let's just have a first look. At the beginning, they just talk about what is depreciation, so you can just read through that. It's at the end of the year. Obviously your assets lose value, and there's certain percentages that you have to deduct from it to basically you devalue your asset. So you can just read through that, and then they tell you that there's two methods, namely the straight line method and the diminishing balance method, and I'm going to do examples on both of them. So let's just go straight line method. As according to this method, depreciation is calculated on the cost price of the asset using a predetermined rate of depreciation. And please focus on that word cost price, because they might not directly tell you and say, okay, use the straight line method to calculate the depreciation. They will just say depreciation is calculated on cost, so then you must know that's the straight line method. Okay. So anyway, so that's a straight line method, and then the diminishing balance method. And according to this method, the annual depreciation is calculated as a percentage of the carrying value of the asset. And we will be talking about that now. And then they're talking about the accounting entries. So you have the depreciation account. Now your depreciation account is an expense account, and obviously your expense account gets debited. Your accumulated depreciation account, and don't worry, we're going to be talking about that. So I know I'm talking a lot of jargon at the moment, but your accumulated depreciation account is, okay, it's also called the provision for depreciation account, and that account is known as a negative asset. So if you should be by now you should be familiar with asset. Let's just go. So you've got your asset. Okay. Increases on the debit side, decreases on the credit side. I hope you can see that. I made that pretty small, but you should have the gist of this already. So all it means is in a negative asset, you will always have a credit balance, because it's a negative. Well, that's what it's referred to as a negative asset. So the negative asset, which is accumulated depreciation, will always have a credit balance until you have to close it off to some account. Okay, so I'm just wiping that. Okay, so the first of all, before we start stressing, we are going to do learning example 2A. All right, so it says here, now, first of all, what I like to do is I like to write down all the information that they're giving me, just that I have it all in front of me. Okay, it says, on 1 April 2005, so I'm just going to write that here. Okay, I just want to see, what did we buy? Or what? It's a vehicle. All right. So let's just go. So we've got a vehicle purchased 1 April 05. That's what it says. For 414,000, 414,000, and that includes VAT. Please, that will be important later. I'm including that, and the financial year end. Okay, so the year end is 31 December. Okay, so we've got that information there now. Okay, so on 1 April 2005, Vortex dealers, okay, they bought a delivery vehicle, non-passenger vehicle, 414,000 including VAT. Okay, the relevant ledger, waka wakas. Wait, the relevant ledger account. Okay, so they say we need to calculate the depreciation. Calculate the depreciation up to, from 31 December 05. Depreciation, so it's from 31 December 05 until 2008. See, those until 2008. All right, so that's basically 5, so 6, 7, 8, yeah, 3. Yeah. Okay, so I just like to write out information, then I know exactly what I'm dealing with. Now, when you calculate depreciation, you always calculate it with the VAT exclusive amount. So here we see it's 414,000, which is including VAT, so we need to calculate the exclusion price. So where's my calculator, which I had here somewhere. Here we go. Sorry about that. All right, so the VAT exclusive amount, 414,123 divided by 1.15. So that's 360,000. Okay, so here, I'm just going to make a note here. So the VAT exclusive amount, what did I say? 360,000. Okay, you should be able to calculate VAT and non-VAT by now. I mean, financial statements is one of the advanced courses. Okay, so let's recap what I've got here. So we purchased a vehicle 1 April 05 for 414,000, including VAT. VAT exclusive amount is 360,000. The year end, 31 December. That is just basically there to tell you and show you where your financial year basically starts and ends, which is also important. So depreciation we have to calculate here is between 31/12/05. That's when we. So it's 31/12/05 until 2008. Okay. So now, first of all, your depreciation works from the beginning of your year, from your financial year to the end of the financial year. So you always need to keep that in mind. Now also, so when I do my calculations for this, I like to just draw pictures and I like to draw a timeline just to make sure that I get all my details ready. So I'm just going to grab my ruler here and I'm going to have to draw quite a long, just going to draw a long line here. I wish I had a longer ruler, but let's do this. Okay. So I'm just going to draw this and there. All right. All right. So the first one we need to calculate is from 31 for the financial year end of 05 until the financial year end of 08. Okay, so let's have a look at that. So first of all, like I say, now we're going to do 2005. Now, as we can see, they purchased it 1 April 05. So in other words, we need to do the depreciation for the first year, the second year. So we have to do it for 205, 206, 07, and then 08. Okay. So they purchased it in 1 April. So let's go. So that's 1 April, May, June, July, August, September, October, November, December. And then 31 December. Let's just check if we are correct with that. So 2005, so this will be 1 April, 1 May, April, May, June, July, August, September, October, November, December. So this is the 1st of December, because this is 1 April. So that'll be 1 April, and then obviously the year end is the 31st of December. So we have to go until then. So this is from April till then. So how many months have we got then? So that's 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay, so the 2005, we're obviously only doing the depreciation from April to December because they bought it in April, so it's not a full financial year. So we need to calculate it and we need to know how many months we need to calculate the depreciations at. So then for 2005, I'm just going to write this here at the bottom. We need to calculate it. Now remember what I said, we're calculating the depreciation, VAT exclusive amount, which is 360. So that'll be 360,000 times, okay, and another thing you need to know, which I did not write down, is your depreciation percentage. And it says depreciation is calculated at 10% of cost. So that is 10% of cost. So in other words, it's 360 times 10%. Times, now remember the 2005 is only for 9 months, so that'll be 9 out of 12 months. Now the one thing you need to know about the reason why they say that this is depreciation on cost is every single year you basically have the same amount of depreciation. So irrespective of what the value is of your asset, it is going to, every year the depreciation will be at the same price or at the same percentage on the same cost price, so your cost price doesn't change at all, and then basically it just adds up until your asset is absolutely worthless. So it's exactly the same, and I'm going to demonstrate it now. So let's just first calculate it. So it's 360 times 10% times 9 out of 10 months, and that gives you 27,000 Rand. Okay, so that's the first one. Now we're going to do the second one, so that'll be for the year 2006. Right, the second year. Now this one is going to be for a full year. Because, remember the first one, it ended at 31 December, and we still have to take it all the way to 2008. Just want to see, yeah, and that goes until the end of the financial year at 2008. So now obviously if it's a full year, it's 12 months. So in other words, for 2006, and once again you use the same cost price, because this is the what do you call it again? The straight line method, which is on cost. So again, it's 360,000 times 10%. Times, obviously 12 over 12 is 1, and that will be 36,000. And then 2007, once again it's a full year, so it's exactly the same. So 2006, 360,000 times 10% times 12 over 12, because it's a full year, and that is 36,000. Sorry, this was 2007, not 2006. And then lastly, we're doing 2008. And of course, again, it's a full year. If it was like half a year and they dispose of it in the middle of the year, you would just calculate the amount of months that it was in the business's possession before they sold it or got rid of it, and you will calculate it. But for this example, it's also 1 year. So it's 2008, again 36,000 times 10% times 12 over 12 months, and that is 36,000. Okay, so as you can see here, that every year the depreciation took place on the cost price, the VAT exclusive cost price, calculated by 10%. Depending on the number of months that we basically had it. So like I said before, I like to draw pictures just to get your timeline in front of you, knowing exactly what's happening, how it's happening, and that you can calculate properly how many months you need to calculate the depreciation for. Okay, so let me just wipe this. I'm just going to keep that up for now. So now, when we have to read this into our accounts, number one. Okay, I hope you guys can see that. I know sometimes the pen doesn't come out properly over the video, but I try my best. So first of all, you're going to need your depreciation account. And then you're going to need your accumulated depreciation account. And then from there, am I going to get in there? Maybe not. I'll just draw it over here. and then you have a profit and loss account. Okay, so now your depreciation, so how you read it in, remember what we said, depreciation is an equity, so it's minus plus, this is a negative asset, which is still plus minus, and profit and loss is obviously an expense, or an income or expense account, depending on where it's going. Okay, so now, like I say, remember, it's an expense account, depreciation, so these will always go into the debit side. So for 2005, so at the end of 2005, I'm just going to write 05, you're going to, in your T account or in your ledger, remember the other leg is, so depreciation, accounting oh man, I am battling today. Accumulated depreciation, those are the two legs that you'll be using. So it's accumulated depreciation is the other leg that you'll be using, and that'll be 27,000. Okay, and that'll be like at the end of that year. Then after 2006, again accumulated depreciation, and that'll be 36,000. 07, 36,000. 08, 36,000. Okay, 36,000, and then obviously the other leg is accumulated depreciation. So here you just write depreciation, and then that'll be 27,000. Again, depreciation, 36,000. Then again, 36,000 according to the year. Wait, 1, 2, 3, 4, yeah, and 36,000. Okay, so that will obviously be signed off every year. Okay, the straight line method is actually really quite straightforward. You just need to know your period, the amount, the period of the amount of months, and you need to know it's on cost price, VAT exclusive, times 10%, times month, and you have to work it, and every month it's going to depreciate by that amount according to the months. So at the end of the year, this has to be written off to the profit and loss account. Now remember, like in accounting, wherever there's a debit, you need a credit. So depreciation gets written over to the profit and loss account. So 27,000 would have gone over 2005, 36,000, 36,000, and 36,000. So at the end of every year, it's going to be sent through to the profit and loss account. So here we've got a credit, so obviously we need to debit it, and that'll be the depreciation, again 27,000. So after every year, you just have to put it in. Okay, so that is basically the straight line method. Okay, it's just always on cost, and it's always based on the same amount, same percentage, just the amount of months will differ depending on how long the asset has been in it. And then you calculate the depreciation, it goes into your depreciation account, your accumulated depreciation account, and then it gets written over into the profit and loss account. Okay, so this is actually quite straightforward. This is actually the easy part of depreciation. So I hope everybody is with me so far, because now next we will be looking at the diminishing value balance method. Okay, so we're going to use exactly the same example as what we've used here, but we're just going to do a diminishing value. All right, let me just wipe this. Like I said, up to now, still easy, I hope. Okay, so once again, we're using the same example as what we've done. The three accounts that will be used are again the same. depreciation. You just go here, depreciation, accumulated depreciation. That's a negative asset. And then again we get the profit and loss account. And that's equity minus plus. All right. Okay, so once again we're going to use the same amount of years, all that stuff. Now we've already actually calculated the amount of months. We already, sorry, I'm so tongue-tied today. It's actually quite early this morning and we've had some bad storms here in New Zealand. So it was quite a hectic night. So sorry about my tongue-tiedness, but as you know, we've already, when we did the straight line method, we've already calculated the amount of months, so I'm not going to draw those pictures again. We had 2005 at 9 months, and then 6, 7, 8 each had 12 months, right? All right, so now how the diminishing value method works. And once again, remember the VAT exclusive amount. Do not be forgetting that. So how that works is the first step when you calculate the carrying value. Now I just want to explain something. You're gonna hear a lot of different terms here. Number one is carrying value. Your carrying value is the same as your book value. Now your carrying value, okay, I'm just going to write it up here. Your carrying value is calculated by taking your cost price minus your accumulated depreciation. Okay, so that's your cost price. Your depreciation account is closed off to your accumulated, goes to your accumulated depreciation account. Just that you know, I've already explained that and showed that when I did the previous method. And another thing you need to remember is all these transactions gets recorded in the general journal as well. But okay, but I'm not going to talk about that. We will see it all as we go along. I just want to check what I've written here. Yeah, so the carrying value, cost price, but we're not going to use that just yet. I just wanted to write it up there in case I forget. Okay, so let's just first start. So first we've got 2005. So how you calculate this is 360,000, again, times 10%, times 9 out of 12. So the first step is actually the same as the straight line method, and that is 27,000. Okay, but now you will recall that this is called the diminishing value. So in other words, every year your item or your asset depreciates by a certain amount of money. So that means that it actually loses value. So the diminishing value method means every year your amount, your cost price will be diminishing. It will be getting less by the amount that the item depreciated the previous year. So when we do 2006, we will have 360,000 minus 27,000 times 10% times 12 over 12. Okay, so you see now how that works. So after you calculate that one, you will get 360,000 minus the 27,000 of the depreciation times the 10% times 12 over 12, and that'll give you, that is 33,300. So in other words, the second year it depreciated by 33,300. So now in 2007 you take, blah, 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 where am I now? You need to take the new cost price, which is 360,000 minus 27,000, and that's 333,000. Yeah. So you take the new cost price, which is calculated by that. Your new cost price is your old cost price minus your depreciation. So it's 333,000 minus your new depreciation amount, which is 333,000 times 10% times 12 over 12, and that gives you blah blah blah. Where's it? So it's 333,000 minus that. So that amount is 299,700. Okay, times 10% times 12. So the new depreciation amount is 29970. So then for 2008, so your new cost price, which is the previous cost price minus the accumulated depreciation, or the depreciation that we calculated. So when we minus those two, you get 299,700, and you minus the depreciation that we've calculated, 29970 times 10% times 12 over 12, and that gives you 26973. Okay, so as you can see, and then once again, I don't really think I'm going to write it in, but you get the point, because it's exactly the same as what we did when we did the straight line method. Is every year this will have to be added to your depreciation account. That gets closed off to your profit and loss account, and then the accumulated depreciation account. Now all your accumulated depreciation account is you're just keeping track of all of it. See, the depreciation only works annually, so after every year it's closed off to the profit and loss account, but your accumulated depreciation account, it always has a balance, and it just adds up, so you can see exactly how much it's depreciated, and you know exactly what value is left. So then you just put that information once again in there, just like you would have done with the diminishing value. So the only difference is the way that you calculate it, which is you take your cost price times your 10% times the months, exactly as the straight line method. But then the next year you take your old cost price minus the depreciation amount times 10%, and then the year after that you take your new cost price, which is that one, the cost price minus the previous depreciation, minus the new depreciation amount times 10%, waka waka. So I think you get the point. So this now is the diminishing value. So every year your asset actually loses value right in front of your eyes. So that's what's actually going on here. It loses value, and you do your calculation up to there. I hope everybody's with me today. I am quite tongue-tied. I do not know why, but part of life. I hope everybody is. I know everybody's dealing with COVID at the moment as well, and that's not always fun. A lot of people are in lockdown. I know we are in lockdown here in New Zealand. So yeah. And I know it can be quite depressing. I actually used the time a little bit to do some extra studying and finish the zero bookkeeping accounting course. So that was quite nice. All right. So as we carry on here, okay. Now we're going to look at, okay, there's an asset register. All the registers where you keep track of your assets, and you keep track of the depreciation, just that you can see what is actually the value of that. So I don't think we need to go through that again. That's just the normal calculations like what we've just done here at the moment. So the next step, okay, I just need to check. I've got a few hundred papers here. I just need to make sure I know exactly what I'm doing, otherwise we're going to get very, very confused very, very fast. Okay, so the next thing we're going to be looking at is asset disposal. Now, honestly, this is the part where I truly got worried when I did this course, and it took me a while just to snap, my educated idiot box. It took a while for it to get in line with what it was supposed to do. Okay, but finally I did manage to get it right. It took long enough, but yeah, but we got it done. Okay, let's have a look. Sorry, I just need to keep track of where I am. I've got so many papers here. When I worked out this lesson, believe me, there's a lot of stuff to remember, and I know that doesn't make you feel any better. But like I always say, relax and just think, what would Carlo do? Okay, so first of all, there's 4 steps to asset disposal, which I'm just going to write down here. Number 1, number 1. Now there are 4 points here in the textbook, right? I'm going to give you a few extra ones which I found just help me do it a bit better. Those are the 4 main points, that's true. But before you do it is number 1, get your T accounts ready. And I'm going to explain that now. Get your T accounts ready. Number 2. Actually, let's reverse this. I'm going to put number 2 1. First, which I think, get all the information in front of you. The info in front of you. So that's number 1. Then, get your T accounts ready. That you have it all in front of you, otherwise you get very confused. Number 3, add the balances they give you to your T accounts. Including how the purchase was, how it was sold or how you bought it, but I'll explain that now. And then number 4, start the process. Okay, so I'm just going to put here, so 1, so A would be remove the cost price. Number B, let's just call it 1, otherwise I'm going to get confused here. So number 2, remove accumulated depreciation. Number 3, add the selling price. And 4, calculate profit and loss. So those are the 4 steps as it says. You calculate the profit or loss, and then after that there's another one. I'm just going to draw a line here. So after this there's number 5 where you have to calculate the new depreciation at the end of the year. Okay, calculate the new depreciation at the end of the year after your asset has been disposed of. Okay, so that's all in a nutshell. Okay, so first of all, let's go look, see, okay, what have I got here? Okay, sorry guys, you're just gonna, please just bear with me for a second. Okay, we'll be doing, okay, yeah, learning example 2B. That's just a little bit of an exercise just to explain exactly how to do it, but I'm going to use, wait, I hope I didn't lose one of my pages now. That's going to be annoying. It's got to be kidding me. Hang on. Oh, no, I didn't lose one of my pages. Sorry about that. Like I said, I've got a lot of pages in front of me. Alright, so let's just get back to it. So first of all, they tell us, okay, Walton Stockist bought all their office furniture on 1 January 06. Oh, I hope I'm going to have a big enough board for all of this. Okay, so in other words, they bought office furniture for 25,000, and they bought this on 1 January 06. All right, have I got it right? Yeah, Waltons bought 2006. 1 year later, on 1 January 07, the business sold furniture. Okay, so they sold furniture for how much? For 18750. That's right, for 18, where am I now? On 1 January 07. Alright, so if you have to put this in the line, this is actually very straightforward, because at the beginning of the year we bought it, exactly 1 year later we sold it, so I don't think I need to put all that information on the line. Okay, so let's quickly have a look. Just want to make sure I've got all the information. General ledger, wow. Okay, so let's just follow Carlo's steps quickly. Number one, get all the information in front of you that we've done. Happiness, I'm happy, you're happy. Now get your T accounts ready. Okay, wait, I'm missing something, sorry about that. That's why you need to read your question very carefully. The total depreciation written off for the first year amounted to 7,500. Aha, very important information. So you've got depreciation for the first year. I'm just going to write this here, depreciation 7500. All right, so now, first of all, okay, you got all the information. Now please read your questions very, very carefully. Don't make a mistake or don't miss any information, because all the information they give you is quite important. And then now get your T accounts ready. So your T accounts is going to be divided into obviously your asset. Okay, let's just go. So this is furniture, depreciation, accumulated depreciation, accumulated depreciation, it was sold cash, So that'll be your bank. Yeah, that's also information. Like I said, you need to try and write down, okay, this was cash sale there. All the information, because if you have it in front of you, it just makes it a lot easier. Bank, and then you need an account for your asset disposal. Asset disposal, and then you have your profit and loss account. Okay, so as you can see now, that is basically every time you're going to, now I know, just want to see, they've got the bank, profit on sale, and they've got all that. So every time you do a depreciation, even if it's not in the example, you need to have your asset, depreciation, the negative asset. Now this one is bank because it's a cash sale, but if you sold it on credit or anything like that, then obviously that'll be creditors control. If you bought something, for instance, if you bought an asset on credit, that'll be debtors control. So this one will basically just be according to what the method that you bought or sold an asset. So it's asset plus minus. Asset disposal is an equity, minus plus, and then profit and loss, equity, minus plus. Okay. So, always have your T accounts that you're going to need. These are the 6 accounts. So let's see, 1, 2, 3, 4, 5, 6. And obviously when we're going to be doing, when trade-ins are involved, we're going to have another one. But for the basic ones, this is what you're going to need. Asset depreciation, accumulated depreciation, bank asset disposal, and your profit and loss account. Okay, so we got all the information. So got information, we got the T accounts ready, and now we have to add the balances they give us. Okay, so let's not worry about, because we're doing the selling price and the sales stuff later. So the balances they give us, they gave us number 1 on 1 January 07. They gave us a balance of 25,000. So they give us that balance. Right. And then they give us, okay. And then they give us the accumulated depreciation. Now obviously, the depreciation will obviously come in here as well because it's 7,500, but they didn't give that to you in the example. I just always put it there that, you know, I keep track of everything. And then, so the accumulated depreciation, this is furniture, if I'm, oh no, the balance, because they give you the depreciation, you don't have to calculate it, of 7,500. So those are the 2 balances they give me. So you add your balances. And then you need to start the whole process. So process number 1, you need to remove the cost price. Okay, so I just want to check something quickly again. Okay, it says the business sold all the furniture for that amount. But now, of course, when you remove the cost price, you have to remove the full cost price, not the selling price. Remember, there's a difference between the selling price and the cost price. So the cost price is 25,000 because that's what you bought it for. So you have to remove it, and this goes to asset disposal. Okay, wait, I'm not going to talk too fast, but I just want to get a pen here. So when you remove the cost price, the other leg to the cost price, oh wait, where can I write this? I need a place to write it. So your asset, the other leg is asset disposal, because remember you are disposing of it. I'm just writing it down, so keep track of that. I've just written that the asset, when you dispose of it, it it goes into the other leg will be the asset disposal account. So when you get rid of it, your leg here is asset disposal of 25,000. And then because you have a credit, you need a debit. So this is furniture, 25,000. Okay, so now we have removed the cost price. So first of all, so it's the cost price that you bought it for. You have to remove it from the books. And then the other leg for the asset you dispose, it goes into asset disposal. Then number 2, we have to remove the accumulated depreciation. So the accumulated depreciation, and that one is also part of the asset disposal, so it goes, so the other leg is asset disposal, right? So now we're writing here asset disposal. I'm just going to shorten it, AD. Asset disposal, they've given that to us, that's 7,500. Now we've got a debit here, so we need to credit asset disposal with accumulated depreciation, 7,500. Okay, so that goes into asset disposal. Then, number 1, so we've removed the cost price, we removed the accumulated depreciation. Now remember, if they don't give you the accumulated depreciation, you will have to go and calculate it. And then, point number 3, so we've done that. Now we need to add the selling price, right? So first of all, we said it is cash. So our bank increased with 18750, right? Because obviously we got it. And once again, your bank account or your means of purchase or selling also goes to asset disposal. Alright, so now we've got the bank. So once again, the other leg is asset disposal. And the amount, how much did we do it? 18750. And the other leg, then remember we've got a debit here, so now we have to take it to a credit. So the other leg is bank. 18750. Okay. So now we've recorded the selling price or purchase price or whatever, and then we need to calculate, lastly we need to calculate the profit and loss. Alright, so how we do it, we go to your asset disposal and you balance it out. Simple as that. So, okay, I'm just going to, so that will be 26250. 26250, so this will be 26250. So the balancing amount, so your balancing amount, when you balance your asset disposal, goes to the profit and loss account. So we've got profit and loss. So obviously you know how to balance this by now. 1250. Now because we have a debit balance, we're going to have a credit balance from asset disposal. Asset disposal, and that's 1250. So basically, if you have a negative balance or a debit balance in the profit and loss account, you made a loss. If you have a credit balance in the profit and loss account, you actually made a profit. Alright, so, but now we are actually not done. Now one thing I actually failed to say or failed to do is, what I usually do is, because all of these transactions has to be transferred into a journal now. So actually whenever you do whenever you do one transaction, just make a note of it that you can just transfer that into the I am so sorry. But you can transfer that into your journal. So the first thing we did, if you look at this, is remember we put the balances in, so that's there. But then the first thing we did was we removed the cost price. So we credited furniture and then we debited asset disposal. So then you just simply go, let's just say this is your journal. So, oh man, I'm really running out of space here. So I'm just going to say, okay, so we've got, okay, that's debit, that's credit. I'm just going to do a little, so we debited asset disposal with 25,000. And then we credited furniture. Remember, that was the first step we did with 25,000. And then you just give your thing to say you transferred cost to asset disposal. Okay, so the second thing now we did, we removed the accumulated depreciation. So what did we do? Okay, asset disposal once again. So accumulated depreciation was debited. Was debited with 7,500, and asset disposal was credited with 7,500, right? So basically you transferred your accumulated depreciation to your asset disposal. That will be your explanation. And then what was the third thing we did? We added the selling price. So adding your selling price. So bank. Okay, now this one you're not going to put in the journal because this one you will do in either your cash book payments or your cash book. Well, depending on what you did, like this is we got money, so this will go into your cash book receipt. So cash book receipt, debtors journal, or your creditors journal. So you don't have to add the payment method of this or the selling price into the journal. And then the last thing we did was we calculated profit and loss. So asset disposal got debited with 1,250 and profit and loss got credited with 1,250. Okay, so technically an easy way to do it is after every transaction you do, like the first one, you take that out, write it into just put it in the journal, then it's already there. Instead of having to go back and then trying to trace your step. So write it as you do a step. That's just a little tip that I've learned, and it worked pretty well for me. So I hope that helps you as well. Okay, I hope you guys are happy. I know it's a lot of information, and luckily you can pause me, or if you don't like my face, you can try and block me out. So, but this is just the first part of disposing of an asset. So let's recap. You remove your cost price, done. And of course it goes to asset disposal. Remove your accumulated depreciation, goes to asset disposal. Add your bank, goes to asset disposal. Balance it, get your profit and loss. Balance it, and that goes into your profit and loss. If you've got a debit balance, it's a loss. If you've got a credit balance, it is a profit that you've made on that. Okay. Okay, so this was just very basic, very easy, I hope. All right, now obviously we didn't have to calculate the new depreciation yet because everything was sold, so there wasn't anything left. So that's only if you've got a pool of stuff and you sell something out of a pool. That means there's a leftover depreciation of the stuff that obviously wasn't sold. Okay. Okay, disposal of an asset from a pool of assets. People, this is the thing that made me grey. Way before my time. Yeah, I think if you can see on the camera, I've actually gone quite grey over a while. Okay, sorry. My cell phone is going berserk. I just want to see what's going on. No, not important. You guys are more important than that. Okay. Alright, so let's play. Now, disposal of an asset from a pool of other assets. There will be times when it's not only depreciable assets that are sold, but one from many. Like I said, the previous example we did, that was just one item. It was the furniture, and we sold all of it. Now this one, now let's say you've got a lot of furniture and you're only selling a table and a chair, for instance, from the furniture or something like that. Situation, okay, will be depreciable assets, okay, left after the sale. That's what I was talking about. These assets must still be depreciated at the end of the year. It now becomes possible to combine the 4 steps of asset disposal with a year-end adjustment. Okay, sorry, I know why my tone of voice is not making you guys very happy at the moment. But let's have a quick look. And once again, I've got all my papers in front of me. Now here, I also, once again, I really need to keep track. So please remember, we spoke about the carrying value, which is the book value, which is your cost minus your accumulated depreciation. So please do not forget that. We will probably be touching on that soon. Alright, so once again, where's my ruler? Let's have a look. The following balances, among others, appears in the books of Jordan Enterprises on 31 December 07. Okay, let's have a look. I'm just going to draw, I don't know how long a line I need, I'm just going to draw one. So if I don't need it that much or that long, forgive me. Alright, so this is 31 December 07. 31 December 07, so we can work on, alright, that's 31. So what do they give me? The following balances, okay, vehicles, so that's the balance, vehicles. Amount, how much? 224,000. Then they give us the accumulated depreciation up to that point. Which is 105,392. Alright, so we've got that. Okay, a delivery value with a book value of 28896 was traded in on a new vehicle bought from Zola Car Sales. Okay, now unfortunately, this is getting tricky. Okay, so delivery vehicle was traded in on a book vehicle. So we've got an old vehicle, and then in the meantime we bought a new vehicle. Okay, so now what was the date? So or keep track of your date. So that was 31. Okay, so now I'm going to just draw a little line here. So then on the 1st, so 01/01/08, that's weird, it's New Year's Day, so I don't know how they got this date, but unless somebody really does not want a public holiday. We purchased a new vehicle. Okay, so we purchased a new vehicle for, I just want to see, do they say anything about VAT? No, they don't. Okay. So 134,400. So we bought the new price. Okay, and then they traded in. Sorry, you need, like I say, you need to get all this information. the trade-in covered 3,136 of the amount. It was done via hire purchase, very important, for 4.5 years. Okay, that's not as important to know, but you need to know that it was on hire purchase. I just want to make sure I've got everything here. Okay. So basically we had a lot of vehicles at the beginning of the. That's why you really need to keep your head about you, and just see the picture, see the transactions happening. So this is, we had vehicles, and the day after we got this balance, we traded in a vehicle and we bought another. And then they also say the balance of the vehicles account on 31 December 08, so this will be at the end of the year. So 31 December 08. You see why I do a type of a timeline? That you can see exactly what's happening when. And that will just help you to do your transactions. And they say the balance of the vehicles was 268,800. Whew, okay. Now let's just see, double check yourself and make sure that you've got all the information. That's extremely, extremely important. So delivery vehicle with a book value. Okay, and they give us the book value. As you can see, I did not write in the book value. Okay, so the trade-in had a book value, which is also called the carrying value, of wait, I just saw that now. Oh, come on. Oh, there we go. Delivery vehicle with a book value 28896. 28896. Is that correct? Please tell me I'm correct. Okay. So once again, let me just check my script notes and make sure I've got all the information in front of me. So I've got the book value right there. Trading covered 31,360. I got that. Yes. So that's how much it covered. That was the value of the thing. So they traded in a little bit more than the book value. So there we go. All right. Okay. So now, I have got so many papers. It's not even funny. Because you really need to keep track of everything. I'm sorry if I'm boring some of you. I know I'm not my old cheerful self. It's been quite hectic. Okay, so now once again, now we have to focus. So first of all, get all the information in front of you. Okay, that we've got. Everything is there now. So I just hope I got every single thing. Alright, so now we have to, what's the second step? Get your T accounts ready. Okay, so how many T accounts do we need? Let's go. So we've got, okay, well, that will be your vehicles. So asset plus minus. You get your depreciation. So equity minus plus. I just wonder how far can you guys see in here, because I don't want to. So now, okay, now we're going here. So we've got your accumulated depreciation. So negative asset plus minus. Okay, let's see. So you've got that. Got your depreciation, accumulated depreciation, asset disposal, it that neatly now. Okay, asset disposal. Okay, now we've dealt with the trade-in. So we're going to either deal with a profit or loss on trade-in. Obviously, you will know if it's a profit or loss after you've done all your all the calculations. So that will be an equity profit or loss, and then you have your normal profit or loss account. And then, of course, it says HP, so in other words, we're going to need a... Oh, I'm running out of space. Will you guys okay, I'll just... Okay, remember this is the last one, I'm just putting it over here because I'm running out of space. I really need a bigger board. And that'll be creditors control. That's a liability minus plus. Okay, once again, let me check my crop notes. So, let's check it again. So first of all, we got all the information ready. Perfect. Then we got our T accounts ready. So remember, you will always have an account for vehicles, depreciation, accumulated depreciation, asset disposal. Then if there's trade-ins, you'll have a profit or loss on trading, or then your profit and loss account, and obviously your bank or your creditors control, or whatever way you sold it. All right. So we got all of that. And then please remember to do your, I'll do the first one or two, to do your general journal just basically as you go. All right, so next step. So we got the T accounts ready. We got all the, okay, first we got the information, we got the T accounts ready, and our next we have to add all the balances, add the balances they give. So first of all, they give us what balances? The balances of the vehicles. So this will be balance 224,000. Right? They give us a balance. All right. What other balance do they give us? They give us the accumulated. They give us the accumulated depreciation. That is 105. Accumulated depreciation is the negative asset, so the balance is, I wrote it down here, 105. Okay, are there any other balances they've given us? Why does it look like I am missing a page here? I hope not. Okay, anyway. So are there any other balances we need to have? Yes, they actually give us one more balance. You see the end of the year balance? They've given it. Now remember, the end of the year balance would usually be the balancing amount for the vehicles. But now they've already given it, so they give us the end of year balance as well of 268,800. Okay, please tell me that's all of it. Okay, let's go. Sorry. All right, so now we've add the balances, and once again, I've got a lot of papers, as you guys can see. Just want to double check. Just want to see if is this the right, yeah, sorry, I just need all my calculations just to make sure I don't talk nonsense. Okay, cool bananas. Okay, and one more thing. Remember what I said previously? You add the balances they give, and with it, you need to add any HP, the hire purchase information they give you. Remember I mentioned it earlier when we did the balances. So technically you just need to just focus and see just what information needs to be present. Okay, so they gave us the HP, that's 134400. So our creditors is increasing. Remember, our vehicles increased and our creditors control increased. This is just normal T account stuff that you learned in bookkeeping to trial balance. So vehicles, it's 134, that, and then creditors control 134,000. All right. Okay, so are we good? Okay. So first of all, we got all the information in front of us. Great. Got the T accounts ready. We added the balances and we added the HP information or payment information if they do give you anything like that. Not the selling price. Remember, the selling price is only if there's a item that you've sold, and like in this case, we traded in a vehicle for this specific transaction. All right. So now, why do I have so many papers in front of me? Okay, so we got the balances ready. So number one, you get all the information in front of you. Get the T accounts, we add the balances, I added the HP information. And now we need to remove the cost price of the vehicle that they've sold. But now if you go through the information, you will realize and see, they did not give us that information. They did not give us the cost price. But what they did do, they gave you the ending balance. So basically we can just go and calculate it by balancing the vehicles account. So that'll be 35, if you add that up, 358,400. 358,400. Okay? So then we have to calculate that. Now remember what we said. Your asset goes to asset disposal because remember you're getting rid of this vehicle. So asset disposal. So if you take 358,400 minus that, that gives you 89,600. Okay, so now we've got that, and we said this must go to asset disposal. This is a credit balance, and here we go, vehicles, 89,600. So we've done step number one. So the only trick then with this one was they didn't give you the cost price, but they did give you all the other information. That's also why I said you have to make sure that all the transactions with regards to the vehicle T account has been completed. And of course, when you purchase a vehicle, that still has to be added. So once you've got all the information put in, you can just do the balancing act and then that. And then when you have to do the journal, like I say, as you do a transaction, now please remember, okay, we've done the creditors control thing, so you can either put, that will probably be written in your CG, your creditors journal, but if you forgot about it, you can put it in your general journal. And then the other account that we've done now is we added, we credited asset disposal. So we credited that with 89,600. We debited asset disposal and we credited vehicles. So it's like I say, as you do a transaction, just write it in, 89,600. So that means you don't have to go back and trace your steps. So we did that now. I put it in the journal. It's done. We don't have to worry about that again. Okay. Now I'm not going to do the general journal now the whole time as I go. But just that you know, whatever thing we're doing here, we will be doing that in the journal. So every single step you take, just put it in the journal. Then it is already done and completed. Okay. So now we've removed the cost price. Now we have to remove the accumulated depreciation. Okay. Now I need to just keep track again. So accumulated depreciation. Now remember that formula that I gave you guys earlier, which says your CV is your cost minus your accumulated depreciation. So we have to look at what information. Now you need to find the accumulated depreciation, obviously, of the vehicle that you've sold. Sorry, just want to check something. Yeah. So you need to get the accumulated depreciation of the vehicle that you sold. So we've got the formula which says your carrying value is your cost price minus your accumulated depreciation. Now they didn't give us the depreciation of the vehicles, in other words, but they did give us the book value, which is the carrying value. So we've got the carrying value and we've got the cost, which we have just calculated now. So we've got 28896 equals your cost price of 89600 minus accumulated depreciation. So obviously once you move it around and you change the formula in that transaction, you can calculate the accumulated depreciation as 60704. Okay, so you basically need to look at the information that you're given and just remember all the different formulas. So your cost, your CV, which is your book value, is your cost minus accumulated depreciation. We've got the cost, we've got the book value, we can calculate the accumulated depreciation. So then once again, once we've done that, accumulated depreciation goes to asset disposal. So the other leg is asset disposal. And that will be 60704, and then asset disposal, that's a debit, so credit. So we've got accumulated depreciation 60704. Okay, remember the accumulated depreciation is a negative asset, so everything works basically in reverse. Okay, so instead of asset disposal, instead of giving it a credit balance where which would be negative, it goes to the positive side. So I know it's a bit in reverse, but if you practice it long enough, it should not be a problem. All right. Oh, sorry. So now we've removed the cost price, check. Removed the accumulated depreciation, check. And now we need to add the selling price. And now I need to keep track again from where am I now? Okay, so the selling price of the selling price of the oh man, I'm getting so confused. Well, not confused. Confusion is the wrong word. Where am I? Removing the selling price. Oh man, I told you I've got way too many papers here. And of course, please just remember that all the transactions we do, just put that down there. So now we have to remove the selling price, and the selling price will be the trade-in value. Now I've made so many notes, I need to follow my own notes now. So 31, so we traded the vehicle in for 31360. So I just want to check where I am now. Okay, so number one, so the trade-in value was 31360, and that is then also considered our selling price. So what happens now is your creditors control. So you have to take your okay, let's just go back. Your creditors control now gets debited because it becomes less. So other leg is once again asset disposal. That is 31360. And then so asset disposal gets credited, it's creditors control with 31360. Okay, so we got that now. So that now is that is now the selling price that has been taken out. Am I right? Yeah, so your trading value is that. Remember, that was your book value. The trading value is basically, because that's what you got for the vehicle that you've sold. So your trade-in value then, that would be considered your selling price. And because you bought the car, trade-in value, they deduct the 31360 from your creditors, basically from the vehicle. So that's why it decreases your creditors control with 31360. And then that goes into your asset disposal. You'll see it is at the credit side, because that's basically money that you got back. All right. And then when we're done with this, let me just make sure. I just want to make sure that I've got everything that I'm supposed to have. Sorry, you have to keep track of everything. There is quite a lot. Okay, I forgot to. Oh, sorry, guys. Guess what? I did forget something. I forgot to write down the depreciation of assets is 16 2/3%, and it is diminishing balance. Okay, that's diminishing balance. All right. Okay, so we need to calculate. Just give me a sec. Okay, so we still need to do that. All right. So are we done? And we still need. Okay, wait, we need to calculate. Let me just do the profit and loss first before I get. Okay, depreciation goes into profit and loss. Sorry, I'll explain now exactly what I'm doing. Like I say, this you really need to get your. You really need to get your head around certain stuff. Oh wait, I'm actually in the future here. Sorry. Please forgive me. Okay, let's just focus. Sorry, like I say, guys, if your head's everywhere like mine, you're going to battle. So we've removed the cost price. We removed the accumulated depreciation. We added the selling price, and now we have to calculate the profit and loss. So in order to do that, we have to balance. We need to balance the asset disposal account. So that'll be 92064. 92064. So because in the asset disposal it's a debit balance, we will know that it's a profit on trading. Profit on trading, and that'll be 2464. And so, okay, so this is a profit on trading, this is a debit balance, so it will be a credit balance over here. And this will be asset disposal. So asset disposal 2464. And now at the end of the financial year, or at the end of the year, the profit will be transferred to the profit and loss account. So we just do the profit and loss, 2465. And yeah, so profit on trading. $2,464. Okay, so please tell me I've got everything now. Okay, so now this, sorry, I know I got a bit confused lately, but like I say, you must see my books look like a coloring in book because of everything. So sometimes, you can, but if you focus and just stick to what we've got here, just the rules, just follow it. See, I actually try to jump ahead to the next step, which I'll be getting to now. But anyway, so let's carry on. So number one, we removed the cost price, right, which we had to calculate ourselves. We removed the accumulated depreciation. We added the selling price, and then we calculated the profit and loss. And we do that by balancing asset disposal. So you balance the asset disposal. So in the asset disposal, if you've got a debit balance, you've made a profit. If you had a credit balance in the disposal, you will have a expense. Okay, you would have made a loss, because once it moves into the profit and loss account, you will see the asset disposal has got a credit balance, so that means you've made a profit. Okay, so that is this just for the basic removal of this. But now remember, I've got one new step that we still have to do, because we need to calculate the depreciation at the end of the year. Right, so we've still got that part to do. So, papers. Now please remember all these steps we've done. As you do it, put it into your general journal. I'm not going to do it, otherwise it's going to take up too much time. So, now we need to calculate the depreciation for the end of the year. So, now what do we know? We know that the depreciation is at 16 2/3%. It is the diminishing value. So, in order to calculate that depreciation, okay, now they've already given us, see, every time it's going to be different. It all depends on the type of information they actually give you. So to calculate the depreciation now, we're going to take the closing balance minus the accumulated depreciation. Now that will be the 105 minus the, remember we calculated, where are you there? Is it that one there? I think so. Yeah, accumulated depreciation. Remember when we calculated that? Of course, we calculated the accumulated depreciation of the vehicle that they sold. So in other words, accumulated depreciation of the vehicle that they sold. Sorry guys, man, I am confusing myself sometimes. Alright, let's try this again. They've given us the balance at the end of the time. So you take your balance minus your starting accumulated depreciation minus the accumulated depreciation of the sold items that we've carried out times 16 2/3%. Alright, so in other words, this will be 268,800 minus 105,392 minus 60704 times 16 2/3%, which gives you 37352. Okay. Like I say, there's a lot of stuff that you need to calculate. And you need to keep your head around it. So they're giving us a closing balance. So remember the closing balance, when we practice the diminishing value, is you take your cost price minus the depreciation. So this basically is your cost price which they give you there. It's your cost price minus the accumulated depreciation, because remember we need to take that off the cost price, right? And then minus, because we have to minus the accumulated depreciation that we've calculated from there as well. You need to minus that as well, because remember that item, that accumulated depreciation is no longer present, so we cannot add that depreciation into it, because the vehicle was sold at the 1st of January. And so then you calculate it. So then the depreciation amount true. Okay. So then the depreciation amount here. Okay. So you've got the other leg is your. Remember what I said earlier as well. Your depreciation. Your other leg is your accumulated. It goes from your depreciation to your accumulated depreciation. So that'll be 37352, and then depreciation 37352. And then obviously you can balance it, and then you will have a credit balance for your accumulated depreciation. And then of course your depreciation account gets closed off into your profit and loss account. So then you can just put 37352. Okay, now I do hope and pray that this all makes sense. I know this is a lot of stuff that we've gone through, and I know that I was a bit confused at some points as well, but that's why I say just keep it, stick to this stuff. I mean, if you guys could see my notes, you'll understand why I got confused, because some of it had to do with that and some of it had to do with that, so it was a little bit confusing, but still. So you remove the cost price, remove the accumulated depreciation, add the selling price, and just identify what is the selling price. In this case it was the trade-in value, and then you calculate the profit and loss by balancing the asset disposal, and then you need to calculate the new depreciation, and the depreciation on the diminishing value is you take your balance minus the beginning accumulated depreciation, then minus the depreciation. You have to remember, you put your depreciation just in brackets, your two depreciations, minus and multiply it by 16 2/3%. Okay, I hope I have not confused you guys too much now. Then, God, what's the time now? It's 11 o'clock in the morning, yeah? All right, so next. Okie dokie. There was a pool, and now we're going to do. Okay, let me just do this thing here. All right. Okay. Okay, now we're going to do one. Let's say, remember I spoke about this earlier. Disposals midway through the financial year. Up to now, we've done a disposal which had to do with, just from the beginning of the year to the end of the financial year. But now, what happens if you sell something in the middle of a year? Please, people, I hope you don't make the same mistakes that I've made. But one thing I know is, just remember, I haven't actually done any of this type of stuff since I did this course in 2010. So that's like 11 years ago. So it took me a while just to catch up again with what I actually learned. So it took me a little bit of a while, but the more you practice it, the easier it becomes. And like I say, just follow the steps and just close your eyes. What would Carlo do? Besides getting confused, you don't want to copy that part of me. But what would Carlo do? Have some coffee and then just slowly and surely just follow the steps And remember, just add the stuff to the general journal as you go, the general ledger as you go along, just to make it easier that you don't have to keep tracing your steps. All right, so let's look at this example. Okay, now disposal midway through the financial year. I am missing another piece of paper. Like I say, lots of paper. It took me a while to get used to all of this stuff again. Like I say, I haven't done this in like 11 years. But I'm glad to see I still remember some of it. But like I say, practice makes perfect. The more you practice, the better for you. All right. Okay, let's go and have a look. Where's our question? All right. So first of all, in 1 October 20 Waka Waka, they a registered VAT vendor, bought a delivery vehicle, excluding VAT. So in other words, we know that you have to calculate the stuff excluding VAT, so that's not really going to change much. It was decided that the vehicle would be depreciated at 20% and according to straight line method. Easy. The financial year of the firm is 30 September on 1 April 2009. The vehicle was sold on credit for 116,932, including VAT. Okay, so now in this example, VAT is present, so please just focus there. And then the general ledger account that are affected, Waka Waka Waka. All right. So first of all, lots of information. Let's scream now and pay attention later. All right. I'm just going to do this. Okay. Why is my pen not? Ah, there we go. Sorry. It's coloring in my ruler. I really need a cup of coffee right about now. All right. So let's just see. First, what do they give us? 1 October 07. So what do we have? Question, 1 October 07, we purchased the vehicle. For the price, cost price is 164,000 excluding. And depreciation is at 20% straight line. Okay. Well, like I said before, straight line is easy. I love straight line, much better than that. All right. So, 30 September. Okay, so the end of this financial year, that will be 30 September 07. Cool. All right. Easy. So we've got that, we've got that. Let's just read further, make sure I've got all the information. On 1 April 09. Ooh. Okay, so now it's getting tricky. It says 1 April 09. Oh man, what's going on here? Have I got the right information here? Okay, wait, it says 1 October. Oh, yes, of course. No, man. April. I just want to double check my information here. The general ledger account that are affected by the information provided for the period 1 October 08 to 1 April 09 would be prepared. On 1 April, the vehicle was sold on credit for 116. Okay. we've got that, we've got the cost price. Getting hot. Oh, sorry guys, like I said, lots of papers. Okay, that's, I don't know, something about these dates don't make sense. So 1 October 07, cash excluded. I think they got the dates wrong, you know that. On 1 October 07, Nested Enterprise registered vendor bought a delivery vehicle for 164,000 cash excluding VAT. It was decided that the vehicle would be depreciated at 20 per annum. The financial year ends 30 September. Okay. On 1 April 2009, the vehicle was sold. I actually think they made a bit of a toffee, because we've got the first financial year is 1 October 07, 30 September 07. But yet they're talking about 1 April 09, so that would mean that 07 to 08, and then 08, then it's 1 October 07. Yeah, guys, if you look at the answers, if you look at basically the answer they've given us, yeah, I hate it when they do stuff and it's totally confusing. Just want to make sure I'm reading this correctly. Sorry guys, I know I'm taking up a lot of time, but if you want you can just forward. It was decided that the vehicle would be depreciated at 20% per annum according to the straight line method. Okay, the financial year is 30 September. On 1 April 09. I think that date, 1 April 09, is supposed to read 1 April 08. Not 09. Okay, so I think it will be 1 April 08, because if you look at the answer they give you, it's not based, because otherwise you will have to have an extra year of depreciations that you would have to calculate. So that was okay, so I'm just going to carry on with this then. Alright, so that's 30 September. So then I'm going to keep drawing my lines. Okay, so this will be 1 October 07. October, so that's November, December, January, February, March, April. So that'll be October, September, November, October, November, sorry, December, January, February, March, April. When did they say they sold it? On the 1st of April, right? So that'll be 1, 2, 3, 4, 5, 6 months. Okay guys, so yeah, I think this is that is just supposed to say 1 April 08, not 1 April 09. Alright. Unless I'm wrong, if I'm wrong, just send me an email and just correct me there, please. I would like to find out. The general ledger accounts that are effective from 1 October 28 to 29. Oh, wait. Man, I'm confusing myself now here. The general ledger accounts that are affected by the information 1 October 08, no, 1 October 08 to 1 April 09. That's 6 months. Okay, no, I'm sticking to my story. So this will be 1 October 07 and this will be 1 April 08. All right, because otherwise this does not make sense at all. Okay, so let's see, what do we have? So on 1 April 08, they sold on credit. So that'll be your debtors journal. They sold on credit. Price is 116,932, which is including. So let's just calculate. So the VAT amount, if you calculate the VAT amount, it's 15252, and the VAT exclusive, that's the VAT amount. And then the exclusive amount is 101680. That's your exclusive amount. Okay, so looking at this now, so do we have all the information in front of us? Like I said, I just think they were wrong, or maybe I'm wrong. I'm not 100% sure. Just, I think, just let me know via email. But the principle of what's going on now has got to do with this. Okay, so let's have a look. So we've got the cost price, we've got that, we've got that, we've got that. All right, so now, just want to double check, have I got all the information? Yes. Okay, 3007, so this will be the new financial, the month. Okay, all right, so first of all, let's get our T accounts ready. So once again, we have our vehicle. So assets plus minus, depreciations, and we've got accumulated depreciation. It's a negative asset. Depreciation, then again asset disposal. That's the equity. So we've got the asset disposal. Debtors control, because we sold it on credit. So debtors, it's an asset. And now this time, remember, we had to deal with VAT. So now we've got, remember, money came in, so it's VAT output. It's liability minus plus. And then profit or loss on sale. Okay. All right, so where are we now? Okay, so now once again, we got all our information in front of you. Now then, get the T accounts ready. We got them all set up. Now we have to add the balances. So the balances, so once again, is the vehicle. It's 164,000. Now, what was one of the other balances we saw that they always used to give us at the beginning of the year? Yeah, the accumulated depreciation, but they didn't give it to us. So now in this case, we need to calculate the accumulated depreciation. Okay, now the question is actually making sense. So now we need to calculate the accumulated depreciation. So okay, so now we have to, so let's just calculate accumulated depreciation. So that'll be 164,123 times 20%, and it's times, well, 12 over 12. So that then gives you 32800. So that's then 32800. So in other words, the accumulated, because we bought the vehicle, and then, 17208. So we bought the vehicle there. The new financial year is from this October, basically until 1 October 08. Anyway, now that's April 08, so that'll be 1 October 08. Okay, so it's 32800. So then that will actually be our balance, because the financial year we are actually working in is 1072, April 108. So this will be the financial year before that, and that depreciation will then be basically the depreciation that has accumulated up to that point. All right, so let's just put that balance in then. So the balance then, accumulated depreciation, is 32,800. Okay, now is there anything else that we need to put in, that we need to be aware about? No, I don't think so. Of course, it looks like it's only the one vehicle. Okay, yeah, looks like it's only the one vehicle. Okay, that is 6 months. All right. So just to save time, I'm just going to calculate the depreciation for that period as well. And because it's straight line, it's very simple. So it's 164,000 times 20% times, how many months was that? 6/12. So then the depreciation amount for this financial year will be 16400. All right, so that'll be 16400. So I just calculated the depreciation. This was the accumulated depreciation up to that point, and this is then the depreciation of the Now I do still believe that they got those dates wrong, but like I say, please let me know if I'm missing something in there. All right, but let's focus. So I've got the 16,400. All right. Okay, so first of all, we got all the information. We got the T accounts ready. Add the balances. So usually it's the vehicle, accumulated depreciation. I think that is it. There's no HP information, except they sold the vehicle, but that will, because that's a selling price, so that we will be adding in somewhere else. Okay, so that's it. And now we have to remove the cost price. Once again, it's the cost price of the vehicle, and that goes to asset disposal. I'm just going to say AD, asset disposal, and that's 164,000. It's a credit balance, so asset disposal will get debited. Okay. Vehicle 164,000. Okay, so that is out. Now remember, general journal, just put that transaction in your, general journal. All right, so we've done the cost price. Now we have to remove the accumulated, depreciation. Okay, so first of all, first of all, hang on, I forgot a very important point here. People, I am so sorry about my weird-mindedness today. Okay, as you know, these are the basic rules. The basic rules for asset disposal. But once you do disposal through in the middle of the financial year, something else has to be added. In other words, before you remove the accumulated depreciation, I'm just going to call it 2.1, you need to calculate the depreciation of the item you are sold. Calculate the depreciation of the item you are selling up to the point, because remember the depreciation that we've calculated up to there, it's on the whole year. And so the accumulated depreciation, so the depreciation needs to be updated up to that point, because remember the asset is getting, they do depreciate more. So that depreciation also needs to be added in. So when you do the disposal of an item in the middle of a year, remember then you remove the cost price, then you need to first calculate the depreciation, and then you carry on with remove the accumulated depreciation, adding the selling price and all that. So please, I know there's a lot of rules, but just when you make the notes to all of this, just make better notes than what I've done. And then just, so remove the cost price, calculate the depreciation. Now, I've already done that there. That's 16,400. So the depreciation there is 16,400. Now, of course, the other leg is accumulated depreciation. Where's that? Accumulated depreciation. That's depreciation. 16,400. All right. Okay, now because they didn't really give us any, since they didn't give us any depreciations, now that's what we've got. We had to calculate it, so we calculated that first year, and then we had to calculate the depreciations up to the date until we sold it. Okay, so then that gets added into your depreciation account. Okay, I am really, really sorry that I am so absent-minded today. I hope you guys are still following this. All right. So then the normal, so 2.1 is calculate the depreciation. So we put it in the depreciation. The other leg for the depreciation is we've got a debit balance, so we credit it. So now in order to do removing the accumulated depreciation, we need to balance the accumulated depreciation account. So in other words, this is 200, let's just add it up, so 6, 7, 8, 9, 4. So that's 4,9,200. Now we all know the accumulated depreciation account also goes to the asset disposal. So then you credit your asset disposal account with the